My name's Adrian Manz, and I have been a professional equities trader going back 16 years now. My wife Julie and I, who's standing right over there, is my trading partner and has been since graduate school. We met in graduate school and started trading our own accounts and building a trading business around some statistical models that we developed, and we never really looked back. So we're both PhDs in psychology, and we both put those to good use, sort of analyzing ourselves and figuring out what our role was in the market and figuring out where other people in the market were coming from. And it's made for a good mix over the years and a very good complement to what it actually takes to succeed in the market, both being psychologists. So it's a business that's based on human beings and what human beings are doing at any given point in time. And I'm not going to lie, the PhDs in psychology did not hurt when it comes to figuring out where we are and what we're doing. But let's get started. Today, everybody is here. We're jam-packed here with people, so try to be courteous of the folks around you, and remember that all this information is going to be available at traderinsight.com next week. You don't need to write everything down. You certainly don't need to take pictures of all the slides. This will all be published, and if you fill out one of those response cards with your email, we'll send you an email when it's ready to go, and you can just hop on the website and pick it up. No need, again, to disturb other people taking pictures and trying to scribble down notes and things. So let's get started. This first hour trading tactics. This is what we do live in the war room every single day of the week. This is first hour intraday trades. We've currently got one of our most successful students running that war room. That seems to be going very well. Frees us up to, quite frankly, to not be running the war room, but to do some other things, develop some new strategies, that kind of thing. So let's take a look at a strategy that's right out of Beat the Street, right out of Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. If those of you who have those books, you know what I'm talking about. Those of you who don't, I am told by Harriman that they have totally sold out here at the show. You can talk to Susan over at Harriman after the presentation, and she can tell you how to get a hold of the books. So let's take a look at my opening gap reversal strategy. This is the one that a lot of you are here to have a look at. In the United States, of course, I called this one Baltimore Chop. The book was written around a baseball analogy. In Beat the Street, it's just called Opening Gap Reversals. And the first thing we need to talk about is range and true range, because these are going to play an important part, at least true range is, in establishing what a valid opening gap is. So stocks range is just that. It's the value of today's high minus the low. Real easy to figure out, right? So if you take a look at a bar chart, we got a daily bar here. The range is just the high price minus the low price. And if that stock had a price of $50.10 at its high and $49.40 at the low, then the range was 70 cents for the day. That's a piece of cake, right? Everybody understands range. Now let's take a look at true range. It's a little bit more complicated, but once you wrap your head around it, all it is the range of the day plus the gap. So a stock's true range today is the greater value of that previous bar, the high minus the low, or just the simple range, or it's the absolute value of the high minus the previous close, or the absolute value of the low minus the previous close. So you don't have a negative number, right? So that's why we're doing the absolute values there. And as you can see, what this does for you is gives you the high price minus the closing price of the previous day, and that's going to be today's true range. And this is a very important construct because we're going to use this as a proxy for volatility. So in this case, if the high price was $50.10 and the close yesterday or the close the previous day was $49, then the true range was $1.10 for that day. So now let's talk about the assumptions for this opening gap reversal. First off, we're assuming a normal distribution. When I say a normal distribution, I mean a normal distribution of volatility. We're also assuming that true range is a proxy for volatility and that volatility is mean reverting. And why are all these assumptions important? Well, because if these are in fact true, then what we can do is get out into the second standard deviation, or the 95% tail of the probability distribution, And that essentially gives us very, very strong reason to assume that the volatility that we're seeing in a market, in any given market, is in fact about to revert to the mean. And that then is the basis for why we think that this opening gap reversal strategy is going to wind up making money. So let's have a look first. For those of you who have no idea about statistics whatsoever, this is not a big deal. Let's take a quick look at what mean reversion is. All we're talking about here is you've got a distribution. That's the mean. That big black line right through the middle is the average. It's the arithmetic average. The red balloons, those are periods of high volatility. The blue balloons are periods of mean reversion. We're moving back towards that average. That's all we are focusing on in this entire presentation about opening gap reversals. We're going from periods of high volatility and reverting back to where we were when volatility was more normalized. So what's a standard deviation? It's the excursion from the average that can be expected. The formula for our example is going to use 10 days of that true range data that we looked at, and it's going to say what is the average excursion that we can expect from the average. So on average, how far can we expect to move away from the average? And using 10 days of true range data, or 2 weeks of stock trading data, right, we get the standard deviation for x 1 through 10. So we're going to sum the 10 values for true range for the 10 days minus x bar. We're going to take the average value of those 10 days. So 10 days worth of sum true range data minus the average true range data. We're going to square that. We're going to get rid of any negative number that's in there. We're going to divide it by n, and in this case is the 10 data points. We're going to take the square root. That's going to give us one standard deviation. Just to be clear, let's have a look at those formula inputs and make sure that everybody understands the page that we're on. Does anybody have any questions up to right now? Because it's important that we understand exactly what we're talking about here. Okay, so standard deviation, x 1 through 10 minus x bar squared over n. Take the square root. X equals each day's true range data. X bar is the 10-day average true range, and n is the number of days, 10. Let's look at an example then how we actually plug these numbers in. So here's some true range data for a stock. We've got day 1 through 10, and we have values for each one of those days. So your software is going to compute this for you. So if you're using Realtick, or you're using TradeStation, or you're using DOS or Sterling or any of the other packages out there, they're going to calculate true range for you. Then you're going to take that data and you're going to plug it in for x 1 through 10. You're going to add the sum of those to this equation. You are going to subtract this average. These are just descriptive statistics that Excel put together, right? So 1.25 is the average. You're going to square that data. You're going to divide it by n, which is the count, which is 10. And that is going to give you that one standard deviation value, which is 0.49. 49 cents per share takes you out one standard deviation from the mean. So you have to add that to your mean in order to figure out what a one standard deviation gap is. You have to multiply it by 2 and add it to the mean in order to figure out what 2 standard deviations are. So now how are we going to use this in the trade? Well, bulls or bears are going to gap a stock open, right? And sometimes it's going to gap 2 standard deviations above the high or below the low of yesterday's range. And when it does, we're going to enter that trade just above the high or below the low of the deepest bar in the gap. So what this looks like on an intraday 5-minute chart is this. On day 1, we had a stock in this case that was moving higher, and on day 2, the gap day, we had this move to the downside. Now let's assume that's a 2 standard deviation move, and then when I say the deepest bar, what you're going to do is treat this opening gap like a pullback. And in this case, the deepest bar in that pullback is down here. So what we are going to hope to do is get long just above the high of that bar, just above the high of the deepest bar in the pullback in the next 5-minute bar. And we're going to target this area up here, which is the open of trading for the session. You can target the open, you can target the close, you can target the high. You can even target into yesterday's range. You're going to have to learn a little bit of discretionary skill in determining what makes for the best target. But in essence, what you're going to find out is that you have to give them a little bit of room to breathe, but that you don't want to give them too much room. So you don't want to make the assumption that you're going to close a $5 per share gap, for instance, on your trade entry. You want to find a target that makes sense in terms of your reward to risk ratio. Give yourself, at least probably a 2-to-1 reward to risk ratio. That's the first place you're going to set as your target, because you're going to set your stop loss right down here, right? It's going to be right around this low of the morning, or it can be right around this closing price of the previous bar, or the opening price of the bar that we're entering the trade in. One way or another, your first objective is going to be to get this trade risk-free. You're going to try to get it to break even as fast as possible. But just remember, when you're setting up the initial parameters on a trade has to make sense. You can't have a 20 cent per share initial profit target and a 50 cent per share initial stop loss. It doesn't work, right? It's not a good way to structure a business at all. So here's what this looks like on a daily chart. This one's a little older, so this isn't a real recent chart here, but it's a nice way of showing you what the two SD gaps look like. We see this gap in Airgas Incorporated last year, and one standard deviation was 49 cents, you'll recall from the data set that we looked at. So two standard deviations is 98 cents. The mean was $1.25. So a gap that's going to be a valid opening gap reversal candidate is going to be the mean plus two standard deviations. So we need to see $2.23 per share on a gap in order for the trade to set up and say, all right, we're going to look to fade this move. So what was this gap? This one was actually $2.84, so it's more than two standard deviations, and we are now interested in what this is going to do, what Airgas is going to do after that opening tick. So here's what the morning gap looked like on a 5-minute chart on this one. The low of the opening 5-minute bar was the deepest bar in the pullback. If you don't like trading them that way, if that's going to give you some consternation about whether or not to take the entry, you can shift to 1-minute bars, 2-minute bars, 3-minute bars, right? It doesn't really matter what the time compression is, just so long as we're looking at the same thing. You want to see what the deepest bar in that pullback is. In this case, it happened in the first bar of trading, so now things are a little different, right, than those rules that we looked at. The rules were ideal. The simple rules that I gave you earlier are going to work most of the time. But if you get an opening bar that winds up being the deepest bar in the pullback, you're just going to use the low of that bar as your entry. You're going to use the close or the open of that bar as your stop loss, and then you're going to use a reversal of two closing prices, which happens down here, as your exit for the position. So in this case, you've got about a 53.80 entry and about a 53.20 exit. And when I say reversal of two closing prices, just look in that circle. We see the bar that made the big drop has a closing price, right? That tick on the right side of the bar, that's your closing price. The next bar has a closing price that's lower. Again, it's this tick here that the laser pointer is showing you, right? So where the green dot is showing up right now, that is the closing price of the second bar in the move to the downside. And then this third bar moves higher and reverses the close of the second bar and reverses the close of the first bar, goes through, negates those closes, essentially just moves back through them again, and that's where we're going to close out of the trade. So there's a little variation on the rules, and I'm sorry that it's the very first example that I'm showing you, but let's take a look at the daily chart just to see what happened, and then we'll take a look at another example. Here, of course, is Airgas on the daily, and we see that the gap did in fact close. It moved all the way back down again. So yeah, over the course of the session, you could have capitalized on a giant move, but this is a first hour trade, and in fact, we're really only looking for these in the first half hour of trading. So if you're interested in sitting there all day, there's a lot of things that you can do. Send me an email and we can talk about some of those, but in the interim, really what I'm going to tell you is focus on the first half hour of trading on these and you won't make yourself crazy. So here's an example using calculated gaps. We're just going to take a look at this first one. This is TripAdvisor. We see that my software has sorted into long and short the opening gap reversal candidates. It just goes through and applies that formula that we were talking about. This is a module that you can get for TradeStation and plug right into TradeStation. It's available from traderinsight.com. This one's called Baltimore Chop or Opening Gap Reversal. It's an ELD file, right? It's about $500, and you just plug it in, and every day it gives you these opening gap reversal candidates. But let's take a look at what these entry criteria wind up looking like with that calculated gap, because we see here that we've got a close way up here on TripAdvisor. We've got a 2 standard deviation opening gap. I'm going to say that's probably more than 2 standard deviations, given it's like $10 to the downside. So now we've got a bar that moves lower. We've got this second bar that moves even lower yet, so now we've got the pullback just the way we talked about in the idealized example. And let's pull up a zoom of those two bars, and you can see here that the deepest bar of the gap is the second bar of the day. The first bar of the day gives us our entry point. Right above the low of that bar is where the close got put in, so we're going to look to pop into a long position right above that. And then we've got a couple of objectives for a first target. The open of the bar is far enough away from that entry price that it makes some good sense as an initial profit target. We can also use the high. We can use Fibonacci expansions. We can use pivot lines. There's a bunch of things that we can do. In this case, I'm going to use a move just below the close, that right tick on the deepest bar of the gap, and that's going to represent where I'm going to place a stop loss. I'm going to go below that, probably down about to where that red arrow is actually, is what I'm going to assume as risk for this one. And that's based on going through and looking at 25 tick data, which we're not going to do here because we don't really have time to go through 25 tick charts, and a lot of you don't even have them. But changing time compression is something you should keep in the back of your mind in terms of how to set stop losses. So let's look at the position management on this one using the 5-minute chart. This happened in the room just the other day. So on 11/5, this was a trade that Rick had in the room for our War Room subscribers. And we see that you entered the long position just above the high of that second bar. And look where we wound up. The long position closed out right at that opening tick, and we really didn't get much higher over the course of the session. So those position management ideas are very, very solid, and they make for a very good way to manage these very high volatility trades. Stop loss again down right around where that red arrow was, just below the close of the second bar. And let's take a look at how you put this order in and how you would get filled on this position on the opening gap. Now, I'm going to tell you, I'm not very good as a discretionary trader. I don't like to have a lot of discretion. It makes me nervous. My friend Mark can tell you that I joke and say that the more discretion I have during a trading day, the more hair I find laying around my keyboard when the day is over with. I like to pre-plan things. I like to load things up and just let them go on their own. So when I have a trade like TripAdvisor, I like to load up my bracket order. This is in Realtick. Realtick is a very powerful trading platform, allows you to preload strategies. In this case, I've got my opening gap strategy, and Realtick knows ahead of time we're going to use a stop limit order for this strategy. All a stop limit is, for those of you who don't know how to structure orders this way, you have a stop price. A stop price is not an exit price. It's a price at which something happens. So a stop price is an activation price. Something is going to happen when a stop price is hit, and in a lot of cases, that might mean you're going to enter a trade based on the activity that happened in the market right there. It could also be a stop loss. It could be, just about anything can happen at a price that you identify as a stop price. It does not mean the same thing in every situation. So a stop price of $72.40 with a limit price of $72.43. What that does for me is says, if TripAdvisor ticks $72.40, then I want to get long the stock, and the worst price I'm going to accept is $72.43. If I hit $73.69, which was that profit target, I want to exit 2,000 shares. I'm going to have a profit of $2,520. And if it hits my stop loss at $72.09, I want to exit. My stop loss will be $680. Then I click on place the order, and we are good to go, right? If it hits $72.40, it's going to get me into the position, and it's going to take care of itself. Now, you could also, somebody is going to ask me about taking a portion of a trade off. You could also set it up to close you out at 50% of the profit target for a portion of the trade. Depends on the size of trade you're going to do. If you're doing a couple thousand shares, this kind of a strategy makes sense. If you're trading 100 shares, don't even listen to what I'm going to say because it doesn't make sense. You're going to pay commissions. It's going to eat you up, and you're going to wind up saying, why did I listen to him? Because selling at 50% to the target really didn't make any sense. But let's say you've got a big order out there. You've got 2,000 shares. You have your stop limit order out. $72.40, $72.43 got you in. $72.09 is going to get you out for a loss. And in this case, 50% of the distance to the profit target, $72.99, roughly 50% of the distance, is going to get you out for a $560 profit on half of your position. The other half is going to get you out at that $73.69 profit target for $1,260. What this does is locks in a little bit of profit automatically. You're not attempting to move stops around. You're not trying to ratchet things over the course of the morning. In the case of Realtek, I can just drag lines and drop them where I want trades to be modified. But if I have something else on, this is a really easy way to manage a bigger position. So just bear that in mind. There's different ways you can pull these together, but using a 5-minute chart and your bracket order entry system makes for a very, very easy morning and a very easy way to manage these trades. Now, in terms of money management, the first thing that I want to do is move my stop to risk-free. So if you're not out of the position at 50% to the target, once you get a move of 50% to the profit target, you want to trail those stops at break even. You want to get risk-free as fast as you possibly can. And if a position moves really strongly in our favor and we hit that initial profit target, we can take off a portion of the position. We can move the trailing stop to the 50% to target level and leave it there. We can trail it higher automatically. Realtek allows us to just enter a trailing stop based on a percent value, based on a dollar value. In that case, usually using about 20 or 30 cents per share. Every time it moves up a penny, it's going to ratchet that stop up, and it's going to protect the open profit that you have. One way or another, if you're not money managing these trades, you're going to lose money over the long haul. You will not make money just leaving these trades open, hoping that the gap is going to close entirely and make you a huge profit on the position. It just doesn't happen that way. The easiest thing, the best thing to do, manage your money actively, trail stops, protect profits. Again, in terms of establishing those profit targets, initial targets for gap openings down, use the high or the open of the opening bar, and initial targets for gap openings up, use the low or the open of the opening bar. These are very, very basic constructs in terms of setting these up. There's other things that you can do as well, but if you want to just get your feet wet with them, try that, paper trade them, and you will see that you get a lot of very good candidates over the course of any given week. Also, you can use fib lines, you can use pivot lines. Those are also good initial targets, especially when you don't have a second bar that's the deepest bar in the pullback, like in that example that we had at the beginning. If the first bar represents the deepest bar, you're going to have to do a little bit of thinking on your feet and get yourself into the position and get a profit target and establish a stop loss. Now, those stops you can establish real easily with 25 tick charts. They remove the time element completely from the chart, plot the trading activity instead of activity for a time compression. So you get ticks based on the activity in the market, right? So if there's 100 shares that go off and that happens 25 times, that's 1 bar of trading then, versus a 5-minute bar, which just occurs over the course of a 5-minute time span. So it makes for a very nice stair-step kind of a view of what's going on in the market and makes it easy to establish some trailing profit protecting stops as well as initial entry stops. So a lot of good trading software includes 25 tick charting, and as I just said, you've got a stair-step kind of a progression of data, and it makes it very easy then to identify support and resistance for position management, and it's a lot easier than when you use the time-based compressions. So here's what those alternate targets look like on these. Here's a pivot move. We see the opening gap. It's the deepest bar in the pullback, and the pattern is going to be the very first bar. So where are we going to target? Use that pivot line up at $37.61. Plot those pivots. They're included with your software. Get them on those charts. They make for very, very useful points at which to predict inflections. I've had a lot of people over the years tell me, pivot lines, I think those just, if anything, they're just inflection points. They're not that major. And my response has always been the same. You're in the business of predicting inflections, especially if you're trading intraday. So get those lines on your charts. They make for good targets. They make for good reversal points. There's a lot of things you can do with them. And once you understand how to use floor trader pivots, they can really add to the bottom line in your trading. This next one is a Fibonacci retracement. We've got this first bar that gets up, and in this case, the entry that we're using is right at the close of the first bar. That's because of that huge tail that it put in. But where do you set a profit target at that point? Right, you already had this giant move up to 62.70. We've got the 6147 open. That represents the range that I'm going to measure for this fib retracement. And then we've got a 6109 and a 6071 area that make for logical profit targets on that entry. And in fact, 6109 takes us out. We see the move down to 6071. That's okay. You've got to take a position. You've got to take a point of action here and do something. So never second guess what you've done. Just always pat yourself on the back for following the plan that you set up, even if you set that plan up on the fly, like you would have in the case of CTAS. Here we've got PCAR. I've got this one on because look at this gap open. You need to make sure that there's enough room under the first bar of a gap higher or above the first bar of a gap lower for there to be a profit. In this case, this is probably a stray tick that caused this, or a series of stray ticks, obviously, since we had an open and then a little bit of a move higher, but price quickly collapsed in any case. So if this is actual price activity, unless you can shift very, very quickly to a 1 minute bar and there actually is activity that drives this stock lower, and it's not just a few ticks that brought it down like this, you're going to pass on this trade. You want to see a first 5 minute bar form, and that bar is going to give you then the cause of action, let's say, for what you're going to do with the rest of the trade. So when you see a bar like this, just pass on it, go on to the next one. Most days you are not going to have opening gap reversal setups. They're going to happen a few days a week, and when they do, they make for good trading opportunities. If you get one that looks like this, just call it an invalidated gap and pass on it. So the 2SD opening gap reversal. Volatility, I have proven to be mean reverting. Other people have proven it to be mean reverting as well. In 2003, I demonstrated that true range was in fact a proxy for volatility, and focusing on statistically reliable trading techniques provides an easy way to capture profits rather than riding the discretionary trading roller coaster. A lot of people take every single gap open and they try to fade it. A lot of people take every single gap open and they try to gap and go. They try to find the continuation on them. And what I'm telling you is, by applying a statistical model, right, a solid statistical principle like 2 standard deviations being caused to assume that there may be a mean reversion coming. Now, that's not to say things can't go out 3 standard deviations. That's just to say that you've got a very good reason for doing something here. That's a much better way to go about your trading business than it is to just sit there and wait for every single gap and to just do something because you want to do something. Finally, the fact that true range is a function included in almost all trading software allows us to avoid having to calculate the things that I tried using for these opening gaps initially. So if you've been around the Expo since 99, you know I used to use the implied volatility of the front month options contract to calculate these. I used VIX correlations to individual stocks over the years to try to calculate these. And I've also used the probability of mean reversion versus gap and go for any given stock. And I can tell you that the average true range as a proxy for volatility has worked as well as any one of those and has required far less work to get it going on any given trading day. So you don't have as much homework to do. You don't have as much on-the-fly work to do. It makes for a very nice way to time these entries. This strategy has been shown to be very effective. I've done peer review journals and magazines on it, and the technique has held up to 11 years of scrutiny. So 11 years I've been publishing on this, 16 years we've been doing it. It is definitely one of my favorite trading tactics. Now let's talk about intraday range scalps. This is the scalper strategy that I've been publishing for some time now. I love it. It goes through, it identifies some very easy volatility to spot on a chart and uses it as a predictor for what's going to happen tomorrow. So areas that constrain trading activity today, I'm assuming, are going to be very likely to constrain it again tomorrow if price happens to trade in that same range, right? So you have to have price move back into a volatility band that you identify in order for that volatility band to do you any good. But when it does, there's a very high likelihood that you are going to have a range constraint, and that range constraint winds up being tradable because we focus on ranges that have clear support and resistance and have high to low swings of about 20 cents. So that seems to be the sweet spot, is about a 20-cent swing. Most good trading candidates also have a range of 75 cents to $1 on a typical trading day. And if the intention is to trade the open, limit the candidates to those stocks that trade more than 10 million shares per day. The reason I say this is because on the opens you can have big spreads. If you want to trade the first half hour or the first hour of the trading session, you want to make sure that the spreads are going to be tight, and the spreads are only going to be tight on stocks that do a bunch of volume on any given trading day. And the easiest way to filter for that is just not to have the low volume stocks on your list to begin with. Here's what the scalper plan looks like. This was for November 6th. Here's Apple, right? I like to say it's almost like an apple a day. We see I identify 3 bands of volatility. That's about all that I can really handle in terms of watching it. I plot all these lines on my charts the night before, and then in the morning it's just a matter of going in and saying, is it coming in this case down because it's a short through 109.05? If it does, I'm going to target 108.84. If it moves down through 108.84 from above and hits 108.60, that's going to be my targeted move. And if it comes down through 108.60 from above, gets to 108.27, that's the move that I'm looking for. And I found these just by plotting volatility bands on an intraday chart. So this would be for 11.5. The plan was for 11.6. You go through, you say, where do the highs and lows aggregate? That's going to be the range that you're interested in. The move between those two bands is always the one that we're looking to capitalize on. And if you look at the chart, you'll see that it's always earlier in the session that the trading is the clearest, tends to adhere to the bands the best. And if we move out one day to 11.6, what we're going to look for are these 3 moves. So those 3 blue bars are going to represent the opportunity that we're looking for from the scalper trading plan. Here it is, right off the opening bell. Right, as I said, you can take a stock like Apple. This thing trades a ton of shares right off the open. Boom, comes down through 108.60. Actually moved up, then down through 108.60. Came down, hit the profit target. You're done for the session. That's if you want to walk away from it. If you want to take this second entry at about 11.20, you can. Just realize that over the course of the trading session, it's going to take longer for the later trades to play out, and it's also going to be highly likely that those are the trades that have the shallowest moves. You're going to have to adjust targets a little bit, get out early, or you're going to have to wait for the move to mature, and over the course of the session, you're going to get this directional move if the market is also moving directionally and it's pulling that trade with it. So the opening moves on these are the easy ones. I just take these right on those lines. The moves later in the session, I'm looking for this little check mark inversion, I call it, where I see a move up through a line and then back down through it. In the case of a short, that's how I look to get into that position. But one way or another, this makes for some very, very reliable trading and some very easy trading. Again, it does not give you trades every single day of the week. There's a way to handicap the market. This is a way to get in front of opportunity, but it's not necessarily going to be the case that you have something to trade every single open or every single hour of every single trading day. So the volatility band scalper plan, right? We're looking for the opportunity to identify ranges that sort of constitute where trading today occurred and look for those ranges then to reestablish themselves in the session tomorrow. High volume stocks, wide range, those make for great first hour trades. Trades later in the session are best when they penetrate the volatility band in the opposite direction of the previous day's trend. You want to look for that check mark reversal and then look for a follow through between the bands. And bands, of course, you can also add over the course of the session. Good example is Yahoo, Alibaba, a lot of these high flyers. They tend to violate yesterday's bands and create a new trading range. All you need to do is look for that range to be established, pop some lines on the chart, look for how well they adhere to those lines, and then you're going to take a risk. You're going to take a chance with it. You're going to say, this is where I think price is going to reverse, and you're going to get in front of that reversal, and if it goes against you, you're going to get out with some very tight stops. So that's it. That's first hour trading tactics. I will take questions from the audience at this point for as long as you have them. If the next speaker arrives and needs the stage, then what we can do is adjourn back to the lounge and we can answer questions for as long as any of you may have them. Once again, thanks to the Traders Expo for treating myself and my family so well, and thanks to all of you for attending today.